Hi guys, Marty with Options Unleashed. Welcome back to another best practice video. Today's video is understanding volatility, implied volatility, historic volatility, IV rank, and how we apply that to option strategies. So today's video, we're going to talk about volatility, the definition of implied volatility, standard deviation. We're going to review that, how it relates to volatility in itself, implied volatility versus historic volatility, something called IV rank, which if you're using the Thinkorswim platform or other platforms, you hear that term a lot, and how it compares to IV and HV, and then different option strategies for implied volatility and how we use them, best practices. So just to review the options trading best practices series that we have, this is number 2 in our series. The first video I did was on position size. If you haven't seen that already, that's probably the most important video that I can tell you to watch on options trading. If you're new to options trading, you definitely want to watch that video first, because again, position size is very important to being successful at options trading consistently. The second video, this video is really about volatility, which is basically the holy grail. It's the X factor in all of our trading, right? This is what we kind of live for in terms of trading. And we'll get into why we do that and some strategies on what to look for and how to do that in the platform. So please subscribe and please hit that notification button. It's important to me to get your feedback in the community and have an options community where we can understand and better understand options trading. So let's get right into it on volatility. So what is volatility? Basically, volatility refers to the amount of dispersion or stability in any given system. So today we're talking about stock prices, option prices. So with respect to prices, this can help us measure the risk, and we can use that to calculate future theoretical prices compared to other prices or historical values. With options trading, you'll hear implied volatility. That's pretty much calculated on the options price of the underlying, and it's expressed as a percentage. We often refer to this as our current implied volatility. It's an important distinction. But what does all this try to do? Why, when we use implied volatility, you'll also hear the term standard deviation and how the two relate. Well, standard deviation is essentially the statistical measure of the amount of dispersion of the volatility. It's the square root of the variance, or in other words, the square root of the average squared deviation from the mean. So what is all that? It's basically a statistical way we can express the dispersion or the volatility in any given system. So the standard deviation pretty much allows us to just express volatility as a statistical number. That's it. We refer to it as sigma. And so looking at the classic bell curve, the normal distribution, a Gaussian distribution or Gaussian, however you pronounce it, you can see this traditional standard deviation chart that we use to express option trades or option pricing. And typically, as you know, that you have a 68% chance of a stock closing within that one standard deviation move. That would be highlighted in that darker blue. And then you have a 95% chance of that stock closing within that 2 sigma or 2 standard deviation move. And remember, a stock can go up or down. We don't necessarily know the direction on any given day. On any given time, you only have a 50% chance of knowing if a stock is going to go up or down. So that's why we have a bell curve here that has the 1 sigma standard deviation is a plus 34 and a minus 34 equals about a 68% probability of staying within that 1 standard deviation. And again, 2 standard deviations is that 95% chance. And actually, if we want to go back to that slide for a quick second, when we're placing options trades, it's important to remember that a stock price can move either direction. If we say that a stock price can move 34%, that means it can move 34% up or down. We're not necessarily sure which direction it's going to go. So when we are selling premium, and we'll come back to this later. So implied volatility versus historical volatility. Implied volatility is what we call the current volatility, again, measured as a convergence function of the Black-Scholes algorithm, which uses the current stock price, the current option prices at the money, out of the money, as well as certain Greeks, which, Vega, which can be used to converge on the value for IV. Historical volatility is the actual historical measure of the underlying over time, usually about a year. So IV rank, and how does that compare? Well, IV rank is essentially just a normalization or an index calculation that represents a ratio of implied volatility to historical volatility and normalizes a value between 0 and 1. IV rank then just gives us a normalized IV that we can use when we compare a stock to current IV to other stocks or indexes. So we can say that one stock is more volatile than another if it has a higher number at this moment. So here's kind of an example of what you can look for in the platform. In this case, it's Thinkorswim. The Thinkorswim platform allows you to graph the implied volatility down here at the bottom. I have a graph here of, I think, Apple, right? And so Apple up in the top left here shows you the IV rank as a percent. It's really just a number between 0 and 1, but in this case it's 13. And down below we see the IV, the implied volatility is roughly 30%. So basically the rank is just a ratio of the implied volatility to the 52 weeks of historical volatility, normalized for 100 based on a percent for 100, and then we get the value of 13. This essentially just says that you have a 13% chance that the volatility will be below this value over the next period. And so volatility in this case, that means that roughly, only 13% of the past has been lower volatility than today. All the other volatility that has occurred on this stock has been a higher volatility. So you would expect, in this case, volatility to rise, or to rise based on that probability. So if you're at 13%, you have a good probability, 100 minus 13, which is 87% chance that it's going to be higher in the future. And now notice on the graph down below that we had a little thing called COVID-19 happen to us last year, and it's still in our rear view window. And this is good and bad. So when we look at historical volatility, we want to use the past 52 weeks of volatility for our calculations. But what happened with COVID-19 is the volatility and the dispersion in stock prices got so high during that time period, it was basically off the charts. You can see here that the historical volatility in this case was so high off the charts that value is going to be used in determining the IV rank, because it's actually all this data up here is included above and beyond what the normal, I drew this line here, this might be like considered a normal level for Apple, but up in here things got out of control with really every security. So these effects of implied historical volatility are going to contribute to the overall number in the IV. So it's going to skew the numbers to make them look lower than they really are. So in this case, Apple, instead of comparing the 31% to an historical volatility that was essentially twice that of the average, I won't do the math here, but you can see that if you use this range instead, you would expect the IV rank for Apple to be probably much lower actually in this case, because the effects of the skew above the range. Um, so unfortunately, the the IV rank is rolling off. So when we get to about April or May in 2021, you would start to see the effects of IV rank return back to normal. So be careful with that value if you're looking at IV rank until April or May of this year. So another way of looking in Thinkorswim, you have the probability analysis window. I don't use this window that much, but you can take a look at this in Thinkorswim. You can set up your probability range. In this case, I chose 1 standard deviation. I look at Apple. I'm looking at the Apple chart. I'm looking out at the March 19th expiration. And you can see that intersection here shows you this curve is your 1 standard deviation move for any given expiration date. So that would give you an idea where the stock price can go. Up in here, you know, it would be the 136, you know, plus that number would give you 55, or roughly 152, and about $120 on the downside. There is a little bit of volatility skew that we'll talk about, where people are typically, you pay a little bit more for put options, put premium, than you would for call premium, because negative news and sentiment can somewhat shift volatility in stock prices. So what's Vega? Vega is basically the measurement of the sensitivity to changes to implied volatility. It's another option Greek that we need to learn. It's not looked at every single day, but it is important. And so as delta is to price, Vega is to implied volatility. It expresses the change in the price of the option for every 1% change in volatility. So volatility skew, as I mentioned, is a relationship between out of the money option prices versus in the money and at the money prices. So out of the money, lower strike prices tend to be more expensive, as traders are typically willing to pay more for put option than calls, given that negative, you know, news or sentiment. Stocks typically can take the escalator up, as we say, and take the elevator down when there's like bad news. So people are pricing in that potential for bad news in those options. So how do we apply this to options? So volatility, as we said, is really the holy grail of options trading. We tend to sell premium when IV is high, and we buy premium when IV is low. Here's an example on Twitter. So the Twitter has earnings on 2/9/21. It's next week. The February 12th expiration is in our next window. Its average IV, and it's only 5 days out, its average IV is 125%. So it's very elevated implied volatility. It actually happens to be a great setup for selling premium next week. We can take a look at the out of money calls and puts, and what we'd consider a couple strategies here would be the short strangle and the short iron condor. So in this case, we would want to look at the 84% out of the money calls and puts on this trade, because IV is elevated, as we saw in that chart. And so one thing to note about the 84%, if we go back a slide, we typically look at the 84% out of the money calls and puts, because if because of the 1 standard deviation move, you have a 68% chance of a stock closing within that 1 standard deviation. We would typically look to sell a put, let's say, at 84% out of the money, because the rest of the percent above it would be, you'd have an 84% chance that the stock will actually close. You would have a so one of the things we do is, when we sell puts and calls, that we want to be at a 1 standard deviation move which is again 68% of the time it's within that one standard deviation, we would look to sell an out of the money put or call at 84% out of the money. The 84% is obtained by taking that, 34 plus 34, which is a 68% chance, but also includes the tail risk of the 2 standard deviation move and the 3 standard deviation move. So this means that the buyer, in this case, the buyer of the put is actually trying to achieve that 15% in the money move, and we're trying to sell that out of the money move. This would give us, allow us to collect the entire premium and still be within that 1 standard deviation risk. So let's look at Twitter, for example. We want to sell the February 12th, which is next week, 48.66 strangle for $1.51 credit. It has a 92% probability of profit, and which would be 0 or more, return on that, not max profit. And it has a 572 buying power reduction, but it has infinite risk. And let's take a look why that is in the platform. Okay, so you can see here's Twitter, the chart. We have earnings next week on 2/9/21. We have, in my view here, I have the chart on the daily, and I have the RSI, and I have a MACD, and I have the implied volatility down here. If you take a look at the Analyze tab in Thinkorswim, you can see the average volatility numbers for the particular expiration that you're targeting. In this case, we're targeting the 12th of February. That includes earnings. So we would expect that option implied volatility is going to remain high until earnings on the 9th. And after that date, you'll get what's called vol crush or volatility crush. We would want to take advantage of selling that premium and collecting that premium on that date or by the end of the week. So we would go look at the, in Thinkorswim, you can actually look at the option chains, either calls or puts, and you can actually choose that you'd want to look at the implied volatility, probability of the money, and your delta. What that gives you is an interesting view where you can quickly look at your probability of out of the money. Remember that we said that we would look at the 84% chance of a stock being out of the money, which would give us plenty of headroom to be within that 1 standard deviation. Because because on that curve, if you look at the standard deviation curve again, that you would want 84% of that curve is above that strike price. So we'd want an 84% chance that the put would be out of the money, or if a buyer of that put bought that from you, they were expecting a 15% chance that would be in the money. We would want to sell that 48 strike price for 52 cents. Then we would also go to the call chain, and we would look at that same 84%, between 84, 83, and 85 here. We would sell that 66 call for 92 cents. And if I hold the control key down in Thinkorswim, I could make that one trade as an execution, which has 2 legs. I'd be selling the call, the short call, and the short put, and I would collect $1.51. Now in Thinkorswim, again, you can take a look at your the background will show you your probability range, your date of expiration that you're choosing, and then you can set your slices to break even on, let's say, next week. And then you can move your strikes into where your max profit would be here, and it tells you that you have about an 85, this gets you back to that 84% chance of being probability of profit, let's say, on this trade. So you're collecting $1.51. But note again, we have We have unlimited risk for puts and we have unlimited risks for calls. And we have a buying power reduction of about $572, which is could be expensive for some traders that don't want to necessarily sell strangles. But for the most part, this is actually an excellent trade. It gives us a good setup into earnings. The expected move, if you take a look at the chart here, the expected move is $6.28. So the way we would calculate expected move is we would take a look at the straddle prices for this, and if we go to the price of 56, we would see here that we have about a $6.30 move for that straddle, and that gives us plenty of room. That gives us plenty of buffer on our strikes to still collect a rather decent premium. So looking at our other example, this example involves selling an iron condor, not necessarily at the same prices, but this selling the iron condor, you can see if you take about the same amount of risk, you can see that you're selling the February 12th, the 47.5, 48.5, 66, 67. You have 4 legs executed as one trade. In this case, I'm showing just the 2 verticals here, the short credit and the short put spread here. And that would total about 25 cents in credit. You can see here that you're risking a lot less to make a lot less, which isn't a great setup, but nonetheless, it is a good trade for earnings. You're risking about, I think, 3 to make 1 here. And then the last trade setup I have for you is you want to bring those numbers in a little bit and get a little bit more return with a little bit more risk. You can sell the February 5th, 12th, 51, 52, the 63, 64 iron condor for a 45-cent credit, and it has a 67% probability of profit. So why to use IV? So remember that volatility is a measure of dispersion in stock prices. The current implied volatility is a calculation based on option price derivatives. We typically see high IV. When we see high IV, we will tend to see that the high IV will tend to move to a lower IV and vice versa. So selling premium at a higher IV will tend to take advantage of volatility moving from a higher dispersion to a lower dispersion, i.e. vol crush. We tend to sell premium during periods of higher IV for that reason. Now note that during earnings trades, you see this very prevalently during an earnings trade. You would expect to see higher IV. You would expect to see that vol crush. Some traders don't like to trade earnings events because they can be very volatile. That's why we saw 125% implied volatility for Twitter. On that example, it's greater than 100%. So as you get to earnings, sometimes your volatility isn't necessarily an accurate prediction of future prices. You can get drastic swings in your stock prices, and some traders might take advantage of that. So, in conclusion, volatility is the holy grail of options trading. Understanding the current implied volatility can greatly affect our option strategies. So in general, when we sell premium when the IV is greater than 60%, and we buy premium when the IV is less than 40%. When it's in the middle, we might take a neutral strategy. We might look to calendars, or we might look to butterflies or other strategies. Sometimes you do nothing. But understanding how Vega as well as Delta and Gamma can affect your current trade management, that's very important. And be mindful of earning events and other sentiment conditions, as well as the broader SPY and the VIX. Because the broader market, the SPI and the VIX, will have an effect as well on all option prices more or less, some more than others, but it's important to kind of take a view, and it's important to look across as well all your trades, just as we did with delta and delta neutral strategies, looking at more than one of your trades. It's important also to see how exposed you are to Vega with the coming events of earnings, different types of events, and also if there is a broader sell-off in the market, you're going to see increased volatility, increased Vega, and that sometimes can put negative pressure on your short puts or your short calls. So you want to watch Vega on your current trades, but you also want to use that implied volatility to your advantage for placing new trades. And again, we look to sell that premium when IV rank is greater than 60%, because that's where we tend to see the biggest risk to reward and biggest payouts, and you're maximizing the payout for the same risk. Again, we're always taking the same amount of risk with our trades. We're trying to take that one standard deviation, but when you have a higher implied volatility, you're going to get more bang for your buck. So I hope you like this video. Please subscribe and hit that notification channel, and look for other best practice series as we continue to put out new videos. And please leave comments and suggestions, and I can get back to you. And again, thank you for watching, and have a great weekend, and enjoy trading next week.